The Retirement Cafe podcast, How the Index Fund Changed Investing Forever, with Robin Wigglesworth. Hello, and welcome to another episode of the Retirement Cafe podcast with me, your host, Justin King. If you're thinking about your retirement or already retired, you're in the right place. My aim is to help you plan for and live a successful and meaningful retirement. Retirement is far more than just a financial event. It's a significant life event, a major transition, which will bring with it new challenges and opportunities. So each episode contains tips, information, and inspiration to help you feel more informed and confident about your retirement. I hope you enjoy today's episode. Hello and welcome. I'm really pleased that you've joined me today, as I think you're going to find today's conversation absolutely fascinating. It's with the Financial Times journalist and author, Robin Wigglesworth, who chatted with me from his homeland of Norway. Now, Robin is the editor of FT Alphaville, the Financial Times financial blog, where he blogs and tweets about the biggest trends reshaping markets and investing and finance across the world. He's also the author of a book called Trillions, which has taken the investing world by storm. Trillions has been described as the definitive book on the past, present and future of passive investing. I found it a truly riveting read, and our conversation unpacks some of the humorous stories and anecdotes from the book that help tell the story of index funds. So without further ado, I hope you enjoy my conversation with Robin Wigglesworth. Welcome to the Retirement Cafe podcast, Robin Wigglesworth.
Hi, Justin. Thanks so much for having me on.
Well, really, I've been really looking forward to our chat, Robin, since we met in London at the Chicago, is it a school for business? I'm not sure. But anyway, you did a fascinating talk, introduced me to your book that I can't believe that I was unaware of at the time, and we'll get to a little bit later. But for those who don't know you, Robin, who are you and what do you do?
Well, so my name is Robin Wigglesworth. Despite the kind of Harry Potter-esque name, I'm actually from Norway, and I live in Norway still. After many years abroad in the Middle East and London and the US and New York with the Financial Times, I still work at the Financial Times, where I was the global finance correspondent until recently, and I now lead the Alphaville finance blog, which is where the FT can be a little bit more irreverent, a little bit snarkier, a little bit punchier, but still write about finance, markets and investing, generally speaking, all day, every day throughout the year.
So I'll get to it in a second, but I have no idea how you timed the time you got to write your book, which is quite a heavy tome. But we'll get to we'll get to that in a second. Now, I mean, where did this love of of understanding finance come from?
By happenstance, really. I mean, like many journalists, I studied politics and history and wanted to be a war correspondent. But when I graduated from university in the mid-2000s, early 2000s, there weren't that many war correspondent jobs for newbie journalists, weirdly enough. But there were a lot of jobs in financial and economics and business journalism. And I knew a little bit about economics because I didn't realize you kind of need to understand that, to understand how the world works. But my first job was covering finance in the Middle East, weird enough, for a little trade magazine. And I just fell in love with it because it felt like sort of drawing back the veil to how the world really works. Or rather than how it works, you understand how little you really know when you understand the world of money, right? Because it's always changing, but you suddenly see and understand so many other different world events a little bit better, at least, if you get money in economics and finance. And, I did get to be a war correspondent briefly for the Financial Times. I covered the Arab Spring from Libya and Bahrain and Egypt. But finance was the first cut. As Cat Stevens said, the first cut is the deepest.
Absolutely. Fantastic. So, Robin, you mentioned a couple of things there, which I think is really salient with our audience, which is I don't know my many. Well, I think we've got at least 3 listeners to this podcast. My mum, my sister, and my wife. But for the ones in addition to that, making sense of their money when they're thinking about their retirement or they're in their retirement is huge, and it appears to most people to be a really, really dark art. And then even once they've kind of managed to wade through the complexity of the tax system and the rules and regulations about accessing their own money, which they, in their pension schemes and such like, they then got to get to this thing about investing, and where they invest and what they do. And this seems to be the thing that you've really tried to unpack over the last few years.
Well, I mean, these are hugely complicated issues. I mean, I often get asked for advice because, I've been writing about finance for a decade and a half now, and I just often have to shrug my own shoulders and say, look, I have a decent handle on high finance, but when it comes to, frankly, tax systems, that's just a whole different can of worms. So I have a lot of sympathy with anybody like me who has to navigate all this stuff. And for people who aren't versed in finance, it's particularly complicated. But yes, I tend to write more on the high financial side of things, so less what individuals should do. But I do hope that through my writing, some of these issues become clearer. And one of these subjects I'm quite passionate about is the fact that, yes, people do sometimes get taken for a ride, either deliberately by some unscrupulous people or inadvertently by people that don't always know better than themselves, and therefore end up having a less comfortable retirement than they maybe should have if they'd gotten the right advice earlier on in their life.
Yeah. So bring me to you. Let's bring your book in, Trillions, which I have shown at the camera here. How a band of Wall Street renegades invented the index fund and changed finance forever. Wow. That's a great title. And there's a few things there straight away that some people may not understand. And I know we have covered it on the podcast before. But explain to me, and our listeners, of course, what is it about an index fund? What is an index fund? Why was this such a revolutionary idea?
Well, because it's so counterintuitive, right? In almost every other walk of life, you go to an expert to get things done. You don't basically crowdsource, getting your plumbing fixed. You go to a plumber, and you go to a doctor if you have a medical ailment. And if you need your money managed, then you go to a professional money manager. And that's kind of how people have been doing it through centuries, though in practice, the professional money management industry has only been around for 100 years or so. And the index fund has only been around for 50. It celebrated its 50th birthday in 2021, born in 71. And I think that's why also counterintuitive, the idea that you go to the expert to get the best outcomes. And also because obviously the industry had grown very rich and fat on the fees that customers pay it. So they weren't exactly keen to spread this wisdom either. Can you imagine if somebody like a gym told you that you could, get thinner and healthier by not going to the gym, as it were? They're not going to do that, right? They want you in through the door. And that's kind of what the index fund was. It's a way to get financially healthier by paying less and doing less. And that's not something the industry really wanted to hear. So it was kind of a secret that they fought quite vociferously against for, frankly, decades.
Yeah. And so to contextualize it, of course, is that what we've got on one side of the fence is we've got these money experts who are going to advise you the right shares, in essence, to buy and to hold, and to buy and to sell, and to buy and to sell. And then once one's realize its true potential, will then get rid of it and buy something else. And of course, these experts are researching, and they've got large, research desks that are analyzing and scanning all the details. But something comes out of the wash, doesn't it? Is that actually all that work and all that effort, which we know, of course, in our world that we get rewarded for work and effort, doesn't seem to hold true.
Well, you can if you are one of the maybe couple of dozen people in the world that are the best at this. But there are very few of them, and frankly, they tend to charge so much for their services, and they are not for the likes of you and me. They are for the sovereign wealth funds, the massive, biggest pension pots of money in the world, a few select life insurers and wealthy individuals and oligarchs. The people that can do this or have demonstrated the ability to do this over time are very few and far between. And frankly, many of the people that we think can do this, in reality, are just there through sheer luck or probability. And this is not to say that they aren't hardworking, incredibly smart people. I mean, the smartest people I have ever met in my life work in finance. It's quite sad, really. But the industry sucks up an insane amount of brain power from every other walk of life because it's so well paid. And they're incredibly hardworking. They work harder than I do. But still, on average, the outcomes are terrible. And it's not just sort of 50% do badly and 50% do well. Over time, roughly speaking, in most stock markets, for example, only 10% of fund managers, the professionals, manage to beat the market. And there are all sorts of really technical or big macroeconomic reasons for this, but it's just a demonstrable fact that we know. And it's one of the reasons why, I think generally speaking, they charge too much for a pretty mediocre, shoddy service. And ideally, more people should save in an index fund that frankly does nothing more than buy all the stocks in an index. Albeit with a caveat that they need to pick the right index fund as well, because there is some snake oil in that industry as well.
Yeah. So, of course, I think it would be very easy, wouldn't it, to think that, okay, if I am a fund manager and I have continually outperformed an index and I've continually selected the right securities, the right shares, the right investments to hold in my fund, and I've moved out at the right time, and as the markets fallen, I've moved out before that, and I've got into the right thing before it went up. That there's an inevitability that maybe if I've done that relatively consistency for 5, 7, 8 years, I'm going to start to think that I'm pretty good.
Exactly. I mean, it's, hope springs eternal, and we tend to think that all our triumphs are thanks to our own ingenuity and hard work, and all our failures is bad luck and or somebody else's fault. And, it's unavoidable, really. But like you say, frankly, this is the example that Warren Buffett, the most successful investment manager in the history of the world, always uses. But if you get enough people together and flip a coin, you'll get a few people. If you get a few thousand people in a room, a few of them will flip heads 10 times in a row. And it doesn't mean they're amazing coin flippers, even though they might think they have some special magic technique. It's just probability.
Yeah.
And that's what we see in investment management, that, you can be really good at this, and you can frankly have a bad run of luck, or you can be frankly really abysmal money manager, but have an incredible run. And we've seen this. People have built up huge fortunes and been declared the geniuses of their era. And then suddenly every single dime they ever made for their investors gets wiped out in one big crash. Or vice versa, somebody who, frankly, calls everything right, seems to have the right technique, but their timing is bad, or something else happens. And that's why it's just very hard, and you should be careful of anybody who, comes and offers you an alluring return stream.
Yeah.
I mean, the favorite example I have, which actually isn't in my book, but since I'm in Norway now, it was actually a Norwegian TV program that once had pitched a bunch of astrologers, a couple of stockbrokers, a few beauty bloggers, and a herd of cows against each other in a stock picking contest. So all the different groups chose their stocks over a 3-month period, and the cows were led out in the field where they'd painted the tickers of every company on the Norwegian Stock Exchange. And where the cows defecated was their stock pick. And the cows did as well as the professionals.
Oh, gee.
But the most ingeniously, the people that made the TV program won the contest. But how did they do so? Well, what they did is they picked 30 different portfolios. And then when the contest ended, they showed the best results. And this was an experiment to show what we call survivorship bias. This is what, frankly, a lot of asset managers or fund managers do, is that they don't show you the results of all the funds that they closed. They show you the result of the best performing one, which is why every fund manager in the world will always be able to show you a beautiful chart with lines going upwards towards the sky. But you should be very wary of that in practice.
Yeah. And of course, bizarrely, if we look back at the data of an index, and I appreciate that we couldn't invest in all indexes. You know, as you might rightly said, we've only just celebrated 50 years of indexing from 71. But if you could go back and look at the index, the S&P 500 since the turn of the century, and I appreciate that you'd have to reduce costs and trading costs within that, and we've only got an index to go on. But actually, just the index return would have served most people very well because of the compounding nature of it.
Exactly. I mean, this is why I always say, like I said, I get asked for advice all the time. And frankly, I see people smarter than me screw up all the time about this. So the only two pieces of advice I ever feel comfortable giving is that, with some caveats, for example, investing in Russian stocks before the Russian Revolution or Russia invading Ukraine, stocks tend to go up in the long run unless you happen to believe in this sort of a cataclysm scenario. And in that case, frankly, your investment returns aren't going to matter much anyway. Stocks do tend to go up in the long run, so it's a very good long-term way of saving money. It can be very volatile, so don't put money you might need next year into the stock market, but it's a good long-term way of saving money. And the best way of saving money in the stock market is through index funds because they're cheap. And as you say, the returns compound over time, but the costs compound over time as well. So the difference between paying, let's say, 1% a year to a fund manager and 0.1% a year to an index fund is massive if you're saving over a 20, 30, 40-year time period. I mean, it will add up to, quite a few extra holidays a year in your retirement versus where you might be otherwise.
Yeah. So I've been a fan of indexing for a while, but within your book, which I'm quite amazed at how you've turned what I would have thought a relatively dry subject, index funds, into quite a riveting read. I mean, it really is. I really do commend it to the audience. But there's so many characters from the bet that you mentioned with Warren Buffett, the bet against any active manager to beat the index over a 10-year period. You cover that in the book. Tell me a little bit about that story.
Well, I mean, the reason why I wanted to write the book, and I felt it needed or deserved a book, was because of that. So the reason why active managers still get so much press in, frankly, places like the Financial Times and elsewhere is because they're human. And we humans love human stories. We like the drama. So if you want to call up Bill Ackman or Carl Icahn or Warren Buffett or Ray Dalio or, the people at the Baillie Gifford Scottish Mortgage Trust, they can spin you a narrative about what they're doing and why they're doing well, why they're doing badly, why they're buying this company, why they sold out of that company. It's understandable to us. But if you call up the manager of the Vanguard 500 fund and ask him, why did you buy this and that? And he'll just say, it's in the index, essentially. It's kind of boring. So that industry never has its rock star spokespeople, really, that you can call up for a good catchy quote that'll come into the FT. But the more when I was writing about index funds, because frankly, it's just become so huge, we just need to recognize how powerful a force it's becoming financial markets. I started scratching around the genesis story of it and discovered that it was just filled with fascinating characters, and that's what I wanted to tell. But, I start the book in the 19th century France and the people that kind of laid the first academic groundwork, but that feels a little bit cruel to dump readers in some fin de siècle Paris and financial theory. So I opened the book with this, I think, this wonderful episode of this bet of the century between Warren Buffett and an investor in hedge funds. And Buffett, is famously the world's greatest investor, but he's always had a fairly jaundiced view of his own profession. He thinks it's just filled with mediocrities that extract rents from ordinary people. And he got really annoyed in the mid-2000s at how many smart people were going to work at hedge funds. Now, people were talking about hedge fund this and hedge fund that. And he said, look, I bet you $1 million that the index fund, the S&P 500 index fund, will beat any group of hedge funds you choose to pit up against it. And eventually there was an investor in the hedge funds called Ted Seides, to his credit, thought, the money's going to charity anyway. And quite astutely, he actually foresaw the financial crisis. So he thought a stock market index fund was going to do far worse than a hedge fund that can bet against the market as well. So he pitted a bunch of hedge funds up against the index fund. It was the Vanguard 500 fund. And as we know now, and I detail colourfully in the book, the Vanguard 500 fund absolutely smashed the hedge fund, the funds of hedge funds that Ted Seides had chosen. I mean, this was, for a Liverpool fan, this was like Liverpool beating Manchester United 5-1 away, and frankly, deserving a few more goals in it. It was embarrassing. Not a single one of those funds of hedge funds managed to beat the index fund. A few of them shuttered before the end of the decade. And it was just Ted Seides actually threw in the towel 2 years early because it was so obvious he was going to lose. And I think it was quite a powerful message in what actually does work. That even when you get things right, like I said, Ted Seides is actually one of those smart, brilliant people I've met, or he's incredibly cerebral and erudite and humble. And he actually did predict the financial crisis. And among those hedge funds he'd invested in was actually John Paulson, who made one of the biggest hedge funds hauls in history by betting us a subprime crisis. And despite all that, the index funds still beat the hedge funds. And that was both because, generally speaking, picking securities is very hard, and hedge fund managers charge an ungodly amount of money for doing this job as well. So it's both performance, it's hard, and there are all sorts of technical reasons for that, and the cost of it is extremely high, and that cost really does compound. It's a bit like, to stretch the football analogy, that you start every game 2-0 down. And if you have some brilliant strikers, maybe you can overhaul that deficit, but essentially if you're investing with an active manager, you're starting every calendar year a goal or two down. And sometimes it might overcompensate, but in the long run, we know that's not a way to win championships.
No. And in fact, I've just met with a client this morning with, a couple of £1 million portfolio that he's transferring over from I won't mention the actual name, but quite an active discretionary fund manager in the UK. And we calculated the costs, and they are north of 2.5%, including all trading costs. And, all fees for everything, custodian and the whole lot. But we've looked at the whole thing over the last 12 months, north of 2.5%. And when I actually look at it, it appears to be an index, but not an index, but a proxy index. The manager has picked, 60% in the US, 5% in the UK, 2% in Germany, 3% in France. It appears to be a 60-40, which is a classic kind of portfolio, 40% of fixed income, 60% of equities, global funds, with nothing, and with not so much even to a point of, right, I'm only going to choose 30 companies to invest in and really nail my colours to the wall. But there is, there's thousands of securities in there. I suppose this is probably something you see on a regular basis.
Sadly, all too often. This has been a term I spend a lot of time going through the archives of the Wall Street Journal, Institutional Investor, Pensions Investing, the Financial Analyst Journal. And even back in the 60s and 70s, even frankly before almost index funds existed, this was known as index hugging or closet indexing. And it's natural, right? And in many ways, that's what index funds or funds started. A little bit of a recondite financial history, but the very first ever investment fund was a chest, a physical chest, where some Dutch merchants bought a bunch of bonds and stuck the contracts in and basically promised not to open the box for 30 years. And that was a passive fund, and it basically invested in all sorts of bonds that reflected the market. But if you're basically doing that job, don't charge active fees for it. Yeah. I mean, at best, I think you're kidding yourself. At worst, you're being dishonest with your clients in a way that is very unfortunate. But we do know this happens. I mean, there's been various studies that show that index hugging or closet indexing is a phenomenon that waxes and wanes a little bit whenever there's more attention paid to it. But especially in the retail space, it is pernicious. And the only thing that really differs when you look at the index or the overall stock market or the stock and bond market in a 60-40 fund and the returns is, the costs. And I think it's a shame. But I once talked to the head of one of the biggest asset management companies in the world, and even he admitted that he recently looked at the numbers, and just in the United States, there was $8 trillion worth of money that was in funds that had underperformed over 1 year, 2 years, 3 years, 5 years, 10 years, and 15 years. Wow. And the money is just so sticky. People don't change. And I think this is one of the reasons why it's so hard, whether it's, people saving for, the kids going to university or their retirement, is that we don't want to spend time on our financial decisions or thinking about these things all the time. We don't switch our bank accounts as often as maybe we could or should. We don't change our mortgage providers, taking advantage of the lowest rates all the time. And when it comes to investment products, you tend to pick something, and it's usually whoever that very smart young man is saying is the best option, and you tend to forget about it for the next 20, 30 years until you are retired. And it's a bit of a shame, but it's maybe an avoidable part of human nature.
Sure. Now, in your book, and I was very interested in the Dutch story that I read last night, actually, about the putting it all in the chest, and I loved some of the bonds that it was, it was toll roads and things like that, some nice recurring income streams, which I thought, they'd be good for your portfolio. You cover a couple of, numerous names in the book, a couple of companies that I use a lot, one being Vanguard, and listeners to the podcast will know that I've talked about Vanguard and Jack Bogle quite a lot in past episodes. But another fund manager that I use in all of my client portfolios, a company called Dimensional Fund Advisors. They feature quite richly in the book. Tell me more about your interest in them.
Well, it's partially the role that the founders, David Booth and Rex Sinkfield, play in the history of index funds. So I think Dimensional is a fascinating company in its own right, but I think its roots and its intellectual pedigree surpasses even the influence of the firm directly, because Rex Sinkfield actually worked on one of the very first index funds when he worked at the National Bank of Chicago in Chicago in the early 70s. And David Booth, who he went to Chicago University with around the same time, he actually worked on the very first index fund under a guy called Mac McCown in San Francisco in 1971. So I just think they were just fascinating characters in their own right. David Booth came from, middle of nowhere, frankly. He was a farm boy. He told me when they moved to the big city, when he was 7 or something, it was a city of 4,000 people. And they had a 3-story building, and he was taken aback by this massive structure. And Rex Sinkfield, his father, wasn't around, so his mother couldn't afford to pay for him and all his children. So she had to put him in an orphanage, and he lived in an orphanage and for a period considered becoming a priest until sort of the high finance came calling, as it were. So I think they're just fascinating people that have, incredible pedigree in the history of investing more broadly, really. So I think the index fund is the hero of my book, but I try to use it as the prism to look at the entire history of investing over the past century, because I think there's so many interesting things going on. And there's been so many books written about banks, for example, but financial markets and investing hasn't quite had the same sort of treatment. And then they got together and I joke sometimes with friends and colleagues, it's kind of the Avengers assemble of the early index fund heroes, because it was Rex Sinkfield and David Booth, but then also Mac McCown was on the board, and the former teacher Gene Farmer. They came together to form Dimensional Fund Advisors in the 80s. And they do indexing with a twist, as you know. So not the sort of very plain vanilla style, all the stocks we could possibly cobble together in a broad plain vanilla index, but they try and lean towards certain firms with certain characteristics, like smaller firms that tend to do better over time, or cheaper firms that also do better over time.
Yeah, and then of course this is at the point, of course, where indexing actually becomes more complex.
Yes, unfortunately.
And what Bogle set out to do, and or going right back to the history books, and what the intention of it actually indexing is, has actually become a little bit more complicated, because of course, in today's world, indexing, there is an absolute myriad, isn't there, of mutual funds, exchange traded funds, and you can pretty much buy an index in anything nowadays.
Exactly, and this is the one thing I struggle more and more with these days. I mean, like I said, I often give the advice that put money in the stock market for the long run and buy an index fund, but what's in a name? Would a rose by now the names smell as sweetly? And unfortunately, there are quite a lot of index funds that do stink. The vast majority of money is in, yes, the plain vanilla index funds. Those are ones that track really big, well-diversified indices like the S&P 500, the Euro First 300, the MSCI All World, for example. I'm deliberately not including the FTSE 100 for specific reasons that you probably know very well, but it's not that a diversified index, and it certainly isn't a good measure of the UK economy. It has mostly some big natural resources companies. So I think the third leg of advice I give to people, if they pry a little bit deeper, is that just be careful about what you buy. Because you can call anything an index. I can slap 3 stocks together and say that's an index of 3 stocks, and that's not really what people should be doing. But helpfully, broadly speaking, the biggest and cheapest index funds track the best indices. So investing is a weird walk of life where the outcomes are better the less money you pay, which is a bit of a weird paradox, but it is true. But if somebody's saying, here's an index fund, it's going to cost you 1% a year, then you run for the hills, because there are twists to it. And then there's stuff in between that, frankly, Dimensional fits in, which are factor funds or smart beta, which is the sexy marketing term for it. And they are funds that, have done a lot of research in seeing what tends to drive returns over time, and then you tilt towards them. And that doesn't mean you just buy all stocks in one thing, but you tend to lean towards stocks that are cheaper, for example, and avoid more expensive stocks, because broadly speaking, value stocks do tend to do better over time. And then you cobble that together into an index, and it's the S&P 500 Value Index, or the MSCI World Value Index, or, for example, Dimensional's origin stories in small caps, smaller company stocks. So you buy all the smaller companies. The one issue I have with them is because the research is pretty much irrefutable. I do worry that in practice, whether you are a person like me, or frankly, even a chief investment officer at a major pension plan or a sovereign wealth fund, humans are really bad at sticking out through the tough times. And the reason why a lot of these factors do generate extra returns over time is because they come with a risk. You buy companies that are cheap are usually cheap for a reason. Smaller companies do generate high returns, but they're riskier. They're smaller companies. So you do go through periods where these factors, or dimensions, as Dimensional likes to call them, just
don't work well, or frankly just bomb out completely. And the best example of that is value stocks. So value as a stock market driver did frankly quite badly since, let's say, 2010, 11, 12-ish. And then by 2019, it was just epically bad. So everybody thought, wow, value is definitely going to come back now. It's going to have a renaissance. And then coronavirus hit us. And value suffered what is the deepest and longest drawdown in human history. People have literally reverse engineered what might have been a value stock going back to the 1700s. And even, during the American Civil War, the Spanish-American War, never before have value stocks done as badly as they did in the basically 2010 to 2020 period. And now they're coming back. So 2022 was actually a really good period for value stocks, relatively speaking. But for me, I saw a lot of people bail on value funds in 2016, 17, 18, 19, 20, and then they missed the upside again. And that's why I think people should be wary that if they do go into these things, they need to know that they're willing to stick out and not bail quite often at the worst possible time.
Yeah. And of course, this is the point that I would counter with someone like me sit on the same side of the table as them. And of course, what we do is we blend our value, our small cap, our profitability, our momentum indexes with broad-based indexes. So even if you've got a period of value not performing, your eggs are not all in one basket again. And then of course, as value comes back, probably means growth hasn't, and the money's shifting from growth to value. So of course, it's putting together what I would hopefully a clever portfolio, an academic portfolio, and actually sit with the clients and go, look, this is normal, this is okay. As I've always said, we're never going to make you a killing, but we're not going to get you killed. And that's the key.
That's exactly the way to do it. And think about it. You're building a portfolio. And frankly, sometimes having somebody holding your hands and saying it's going to be okay is frankly one of the most valuable things you can do, because we do know that actually ordinary investors do badly in the long run, not just because they choose bad funds or they choose bad stocks, but they also tend to panic or they drive in herds. And having a sensible person there to sort of calm you down is actually a helpful thing. It's frankly the one service that active fund managers tend to undersell because it sounds so bad. But the one valuable service I do think they do provide is that some people like having a human fund manager they can praise or castigate when things go badly or they do go well. I think that is actually something that's valuable. We're humans. And it's one of the reasons why I'm always been a little bit more reluctant about some of the people without advice or knowing what they're buying go to buy an ETF on some sort of fund supermarket, for example, and go to the ETF that's done the best over a certain period of time. And for example, they would have bought a growth stock ETF that did phenomenally in the decade up to 22, and then basically now has had multiple years of returns just wiped out in one of the biggest growth stock market setbacks in history. So yeah, I think combining these factors in a judicious portfolio and with like somebody holding your hands is the right way to go about it.
So Robin, I hear from you often through FT Alphaville. Obviously we can get your book. Tell me where people can find you, where they can hook into what you're saying, and where they can get a copy of your book.
Well, the copy of my book they can get from most booksellers. I'm certainly at Amazon, but also Waterstones and elsewhere. Daunt Books have had it quite prominently, which was very kind of them.
I think it's published by Penguin, I think, isn't it? Yes.
Yes, Penguin UK in the UK, Penguin in the US, and you'll soon be able to read it in Taiwanese, South Korean, Japanese, Chinese, and a few other languages. And where they can read my stuff. I mean, I'm actually privileged to work at the one free part of the FT. It's a secret I'll share with your listeners, but don't tell too many people about it. But the FT is egregiously expensive, which I'm glad for because it helps pay my woeful journalist salary. But FT Alphaville is actually free. We just keep it secret that it's free. All you need to do is register with an email and you can read it for free. And I write about a lot of these issues there, albeit more from a snarky point of view rather than sort of a personal financy view. And when it comes to contacting me, I'm obviously on email, but Twitter. I'm a journalist and I'm a slave to social media. Sometimes I love it, sometimes I hate it, but I spend a prodigious amount of time on Twitter, to my family's immense consternation. But yeah, and I talk to people there all the time, so definitely hit me up there if you have any questions. And chances are, whatever time of the day it is, I'll probably be logged on and reading and answering.
That's wonderful. That's wonderful. Well, I really appreciate your time this afternoon. It's been fascinating talking to you. I love meeting you in London that time, and hopefully we can see each other again soon in the flesh. But I really appreciate your time this afternoon.
No, thanks, Justin. Thanks for a phenomenal interview. I really enjoyed it.
Thanks once again to Robin for joining me today. To follow Robin's views and commentary on FT Alphaville, check out the show notes on our website for that link, and also some other links, including how to connect with Robin and buy his book. As always, if you've enjoyed this episode, please do leave us a review on Apple Podcasts, as it really does help more people like you find us. And for more interviews and retirement planning videos, you might want to check out my YouTube channel. Just search for Justin King MFP or click on the link in the show notes. And of course, if you want to get in touch, you can reach me on hello@theretirementcafe.co.uk or on Twitter @JustinKingCFP. So until next time, I'm Justin King, helping you feel more informed in your retirement.